Growth versus value is not as black and white as it appears to be. Value managers can outperform during periods of time, as can growth managers. I think that we're in an environment where, as a growth manager, you also have to be very careful about what you pay for businesses. You can't be a growth manager without being a value manager. And so very often it's much more of a gray area than a black and white area. One of the more recent additions to the portfolio is a Chinese company that focuses on the education market. And that company has an enormous tailwind of growth as the one-child policy in China was abolished recently. And with the recent depreciation in emerging markets, the stock price has come down significantly and has provided a great opportunity to add it to the portfolio.
We don't know what the volatility of the market's going to be, although if you're invested in equity markets, it's safe to say that there will be periods of volatility. But don't look at volatility negatively. Volatility creates opportunity. Volatility is our friend as a stock picker. We know our clients would rather have smooth markets in order to deliver the kinds of returns that we want to deliver. We need that volatility to create the opportunities that we then take advantage of.
Rising interest rates are around the world are a potential headwind, as well as some of the issues that are happening with trade between some of the various countries. The tailwinds continue to be relatively strong economic growth in many countries. Unemployment levels are relatively low, but we continue to think there's going to be more volatility going forward than we've seen the last few years. And so that's causing us to be as aware of potential opportunities and short-term disruptions as we possibly can be. I would highlight a couple things. The first would be the experience that various members have had with other very successful investment firms. The second would be we go about finding the ideas that we invest in very much on our own. We have the experience of having 2 decades of looking at international global businesses. These things allow us to come up with ideas from our research trips that we're not going to find reading the newspaper or talking to investment analysts from Wall Street banks.
Well, emerging markets do look cheap, but it doesn't mean they can't go cheaper. On a longer term basis, not only the stocks have been hit hard over the last 6-7 years now, but also the currencies are depreciated. And I think they do look very cheap relative to any sort of purchasing power parity or any sort of valuation matrix. There are some sectors where we've typically had less investment versus others, because sometimes you might find really good businesses in sectors which may not necessarily be flourishing as such, because they could be the new players who are actually disrupting the space. We typically don't look for companies that are disruptors. However, we end up owning some of the companies which tend to be disruptors because they do have the headroom. The managements tend to be very passionate about what they're doing. They tend to have a lot of skin in the game or insider ownership. And Facebook is a very good example of that.